Hello everyone. Today let's look at the dot-com bubble. Now to understand dot-com bubble, we'll have to look at the Nasdaq Composite Index. And that too we'll have to look at it from a 20-year span from 1995 to year 2015. So what is Nasdaq Composite Index? Let's look at that. Nasdaq Composite Index is nothing but an index comprised of more than 2500 stocks, and maybe we can say in around 2000 or 1995 the share of internet companies or dot-com companies was much higher. At present it's at 50%. At that time it was around 60 to 70%. Now one interesting thing happened in 2000, March 2000, that the Nasdaq Composite Index hit the highest of 5048 on March 10th in 2000, the millennium year. So it had risen from the levels of 1000 in 95 and went up to levels of 5000. But then, since this was a dot-com bubble and it crashed in next 1.5 years, the index fell by 80%. Now this is not a stock, this is an index of more than 2500 stock, and it fell by 80%. Imagine the number of people who would have been invested during that time. And if by mistake you had invested in the highest levels of around 5000 levels, then what the portfolio would have looked at the 80% downfall. Then again from 80% it went above to levels of around 2800 in year 2007. But then again it fell from there by around 60% in 2008 subprime crisis, and then again it went up and reached the same levels of 5000 level in 2015. Now imagine the time that went into this. So it was 15 long years that index had to take to reach the same levels it had gone back. So from 1995, the level of 1000 it went to 5000, again 1100, and then back to 5000. So if you had invested around March 2000, then 15 after 15 years the break even would have come, and that too break even like 0% of return, and in between there was minus return. Now this is just on the index front. Let's look at some of the important stocks or the internet stocks that had been there and what had happened with those. So Amazon was around $100 in late 1999, but then it fell by 93% in 2001, and the stock was trading at $7. This decline was up by 93% from the peak. Second is eBay. eBay was around $60, but then it fell significantly, and then afterwards it stabilized. Cisco was trading at $80 in March 2000, and then it dropped to $8 a share. That was around 90% decline. Intel was at $75 during the bubble, and then in 2002 it was $15, roughly around 80% drawdown. Oracle was of $45 a share, and then it went down to $10 in 2002. Now these were the top 5 companies which were there at that time. But then there are many IPO companies, more than 100, which had gone bankrupt. Few of them I have taken over here. One was Webvan. So this was in 99. This was an online grocery delivery service. This was listed at $30, and then in 1 year it went less than $1, and then they had to shut down the business. Boo.com was a fashion retail giant, not a giant but a fashion retail player, with a valuation of $135 million in venture capital. In 18 months it had to close down the business. eToys was valued at $84.25 in October 99, and within a year or 1.5 year the stock was worthless. Then pets.com was valued at $300 million, and it went bankrupt in November 2000. Cosmo.com was valued at $280 million, and then again in it had to shut down in 2001 April. Garden.com was trading at $20 a share, but in late 2000 the price had fallen to just 9 cents. Now these are few stocks which we have discussed, and there were more than 100, like 100 IPOs that had come out just for the dot com or the internet companies that were called at that time. Now the dot com bubble was a rapid rise in US technology stocks. Basically everyone thought any company name which was having .com in its name, it was listed and it was getting huge valuations. So then afterwards, because of this, the market went into bear phase, and the bubble was burst. So why are we looking at the stock market crashes? So one is to learn that the stock market or indices can also fall by 80%. When indices are falling by 80% with which is comprising of more than 2500 stocks, and that to such a strong market like US, imagine how or what can happen in Indian market. So we have to keep this in mind, that stock market can crash, and the crash can be very dangerous, or it can be a very steep crash. Second is try to save ourselves. So what trying to save ourselves is, we should not invest without keeping these things in mind, and we should know that even 80% of fall can be there. If a company like Cisco, a company like Amazon, or a company like Intel had 80%, 90% drawdown, imagine what it can happen if there is sudden chaos in the market. So this is not to make us worry, but to keep in mind that things can go down in market, and they can go down pretty well or very steep. And it's not every time that the fall will be just 30-40% and the rise will be immediately. Like for example, in COVID, the market fell by 30-35%, but then the recovery was within 6 months. It is not that recovery will be always in the same levels. Here it took 15 years. So these things we need to keep in mind. I hope you like this channel, and do like, share and subscribe to my channel. It will help the channel grow. Thank you.